Hi there. Welcome to The Street on BNN Bloomberg. I'm Lindsay Biscaya. Coming up on the show today, Greg Newman, Senior Wealth Advisor and Portfolio Manager at Newman Group, Scotia-McLeod, will be with us for the hour. Then in 30 minutes, Hans Frech-LaRosa from the Center for Advanced Hindsight at Duke University is joining us to talk about sports betting. And we want to hear from you this morning on First Call. You can call us with your questions on North American equities and option strategies, and we'll have Greg Newman answer as many of them as you can. The number to call is on your screen right now, 1-855-326-6266. And the phone lines will open in about 30 minutes from now. And our email address is firstcall@bellmedia.ca. And now here's some of the stories we're tracking for you. Shares of PayPal are plummeting in the pre-market today. This comes as the financial tech company says Chief Executive Officer Alex Chriss will be replaced by HP CEO Enrique Larose. This comes as the firm's profit and revenue fell short of expectations. The firm highlighted weakness in U.S. retail spending and headwinds internationally as driving factors. PepsiCo topped fourth quarter revenue expectations, benefiting from robust demand from its sodas in international markets, as well as strength in its low sugar beverages in the U.S. The beverage and snacks company says it's cutting prices by as much as 15% in some of its key brands, including Lay's and Doritos, in a bid to lift its sales. And Canadian Pacific Kansas City says it set a new record for shipping Canadian grain and grain products in January, both by the amount and the carload. The Calgary-based company says an effective crop year, winter planning, and demand forecasting helped to prepare the railway. Last week, the railway operator also reached a record high in fourth quarter grain revenue driven by a bumper crop. And now to our top-line story for today. Robust earnings from Palantir Technologies sparked a rally in technology stocks, while PepsiCo and pharmaceuticals Pfizer and Merck & Co. all reported earnings this morning. To check in with the market movers, we're going to bring in our guest host for the hour, Greg Newman, Senior Wealth Advisor and Portfolio Manager at Newman Group, Scotia-McLeod. Good to have you in studio.
Hey,
Thanks
Lindsay.
for joining us.
Yeah, thank you very much.
There's a lot to go over this morning.
There is.
Yeah, let's start with Palantir.
Okay.
Earnings are coming out today. Some good news maybe for the company after a bit of a weaker stretch for Palantir.
Yeah, well, it's one of these companies that so much hype, right? And it got towards $200, and there's been, a little bit of, I suppose, healthy fear and skepticism over the last couple months, and the stock's pulled back a little bit. But this is one of these for real companies. I mean, it's tough. It's tough. It's growing at, maybe 30, 40%, but it trades at around 121 times PE. So it's very hard for people to get their head around. However, if you look at it on the rule of 40, which is revenue plus margins, for software companies, they want to see greater than 40. These guys are at 127. So they're really blowing it away. And, they're really making America, and its defense complex a lot more lethal. So they're really, really good at what they do, and the market is really applauding them for their earnings last night. It's
an expensive company, right? The Palantir are the most expensive on the S&P 500. So are you surprised at kind of like when it's doing well, like in terms of this latest earnings report, other tech stocks are kind of rallying behind it?
So there's no question. That's a great question. How much bullishness is out there, and is this kind of a gauge of that? To a certain extent, yeah. I mean, we're not in a euphoric camp for AI right now. I would say that we're in a more sober environment than we were like maybe 3 months ago, 4 months ago. But I think that Palantir deserves to be trading where it is right now. And, it's a high-risk name. I don't think you want it necessarily in your RSP, but I think you can still buy this name for growth.
Okay, let's move to another company, PepsiCo. Earnings coming out today, and as we were just saying in the headlines there, cutting Lay's Dorito prices as much as 15% to try to boost sales. I mean, what are your takeaways from PepsiCo?
They still got this activism involved from Elliott Management that's trying to fix their lineup.
Elliott Management is just involved in so many.
They're kind of in everywhere, right? They are. I like that they're doing their buyback. I like that they beat. But really, when you step back, it's a pretty pricey name for its growth. It's trading around 20 times, growing around 7 or 8%. Look, I think there's better alternatives in the market for investors than PepsiCo right now.
You do. Okay.
Yep.
Okay, let's go to the healthcare sector. Pfizer and Merck & Co. Do
Yep.
you want to start with Merck & Co.? I mean,
Sure.
They reported today, too, shares dipping.
The knock on this stock, and it was, dead money for a long time, was that people are really concerned about Keytruda and that patent coming off in 2027. And I think the market wasn't really realizing that they really are filling up their pipeline pretty well, and the stock got too cheap. And I think that, that was around $80. Now the stock's had a big run. Today, their earnings look okay to me. I think that this is a well-priced name for its dividend, for a price to growth. I think you can buy this name.
What about Pfizer? So Pfizer reporting, are they still kind of in the top there?
Well, no, they really blew it with, they bet everything on, or too much on COVID, and then Paxlovid, and that kind of fell apart. People are really worried about their pipeline as well, but they're really moving into oncology. And the thing about Pfizer is it's very cheap, pays a great dividend of 6 or 7%. No real growth yet, but it's interesting from a value play. I like Pfizer as a value play and getting paid real nice dividend to wait.
Yeah, dividend.
So I'd buy that.
You buy that? Okay, 6.45% is the yield right now. PayPal also reporting today, replacing their CEO. Is that a smart move at this point?
Well, listen, somebody's going to make money on that at some point. It depends what your time horizon is. I think they got to be a takeout play or something like that. I mean, they got too many competitors. They got Visa, Square, Stripe, Shopify, Venmo. I mean, everybody's in that space. Apple Pay. It's very cheap. It's very cheap. Its earnings are around 531. Stock's trading at 44. It's PE under 10. But this has just been one of those classic value traps. You could have said the same thing about the stock at $70. Now it's like dipping down to 44. So yeah, at some point you want to buy it, but and somebody's gonna. There's many different ways to make money in markets, and this is one. If at some point this is going to get overdone, but it's not for me. I'm avoiding it.
You're avoiding it.
I'm avoiding it.
All right. So these are the big ones. We kind of went over the big market movers for the morning. But I mean, if you take a more general look at the markets, like we were talking off air before we started, it feels like January was a lot longer than just 1 month, right? There's so much volatility in the markets. It seems as though February, we're on the third day, so maybe early to say, it's a little calmer. A little less volatility? Or
well, I don't know. Disagree? I mean, yeah, I guess so, because January 31st was a real banger, right? Like, I mean, look at that. Like, silver fell 30%. So, I mean, that's a nice crescendo to the end of the month. So far, things have been really good.
3 days in to February.
February. But if we're talking like earnings season thus far.
Right.
Earnings season thus far, have come in around 15%. And most, I think 80% of the companies have beaten. So I think so far, the bull thesis is holding of not crazy inflation, relatively tame inflation, and really good earnings and a good economy. Not that there's not knocks on that, not that there's not problems with the consumer, but people are still spending. And that's the U.S. story. And I think the Canadian story from all this nation building and all this kicker in metals has even been better. So, you've had a 30% pullback in silver, but these silver companies are going to just mint incredible margins and free cash flow. Now, whether that's enough for these stocks to go forward after, what's going on in the metals market and what it means in terms of the U.S. dollar and the basement trade and what's really going on there and the new appointed Fed that's likely. I mean, there's a lot going on that we can discuss whether or not we should still be buying those metal companies.
Okay, we will be discussing that a little later. Okay, Greg, you're going to stick around. We're going to take a quick break right now, but up next, we'll take a look at the markets before the bell. Welcome back. We're going to take a look now at how things are shaping up on the markets, beginning with the U.S. futures this morning. You can see the Dow is down ever so slightly, basically unchanged actually at this point. NASDAQ and S&P 500 are up ever so slightly. Palantir's earnings, of course, coming out today. We were just talking about that, potentially boosting the S&P 500 a little bit. And if we take a look at how major Asian markets finished the day, reviving today as the price of gold also rebounds. Important to note, actually, the Nikkei closed at a fresh record high, driven by strong earnings from the tech and finance sector. Obviously, those markets closed now for the day. And if we move over to Europe to look at how these markets are trading currently, the FTSE and the CAC 40 are down at the moment, but the FTSE has been seeing some gains and record highs this week so far. Banks also outperforming across Europe this week, potentially driving those markets up a little more. And we'll take a look at where the TSX finished the day yesterday. You can see it was up by 0.8% to finish the day, moving up after quite a loss last week. If we look at some of the biggest winners and losers on the TSX from a percentage standpoint yesterday, Aritzia, one of the biggest winners, up almost 7%. 5N Plus also up almost 6%. Energy Fuels and Eldorado Gold down. Eldorado, of course, having that merger and acquisition announcement yesterday, which drove the stock down. It was down, finishing the day almost 9%. Take a look at the price of metals to start your day. Gold and silver rebounding today. Silver up almost 15% at the moment. Copper also up. This comes after a state-backed industry group in China has started calling for stockpiling of copper, and you can see the price rising, potentially partially because of that. And if we look at the price of crude oil, oil's up at the moment. It has been falling on the prospect of talks between the U.S. and Iran, currently, though, up by 0.5%. We are back with Greg Newman, Senior Wealth Advisor and Portfolio Manager at Newman Group, Scotia-McLeod this morning. And you're making the case for forestry stocks. And this, as I was saying in the break, we don't talk about these stocks very often.
Nobody's talking about forestry stocks. Listen, on the morning show, I don't know, 5-6 years ago, we were talking about Peyto Energy, but nobody was talking about it at $1 to $2. Another time on a morning show, we were talking about Bombardier when it was maybe $10 or $15. They didn't go in a straight line, to infinity like they have. But the time to look was when nobody else was looking. Mm-hmm. And I think you could say that about forestry stocks. I mean, deep value, they're trading 50 to 90% below replacement value, 20 to 40% below mid-cycle fair value, at decade lows. The real key here is not a housing theme. It's that buyers will need to restock in the spring, and that should lift demand and lift these stocks. So, but the kicker on top of that is if the new Fed governor that comes in, if he does come in, or she wants to lower rates, he believes that AI is ultimately deflationary, and so we should have lower rates. If that's the case, and if the market believes that, and if he's right, you're going to have a lower 10-year bond in the States. And if you get a lower 10-year bond in the States, that's going to start fueling housing demand in the U.S. And then you're going to really have not just a restocking rally, but a real serious demand-driven rally and a play in the housing market. So
it's interesting, you don't think about, well, I didn't at least think about that connection between, if there's less demand for housing, then of course forestry stocks are down. Is that why they're trading, though, at decade lows? Like you mentioned, they're trading at decade lows.
Well, no, I mean, it's that the housing market is depressed. It's that the housing market in the U.S. is locked because people can't really sell because of their lower mortgages and rates are higher, and the 10-year is stubbornly higher than it ought to be. Or maybe it's as high as it ought to be, but that is slowing demand. But I mean, obviously, there's also all the tariff noise and the back and forth, but that's already factored into the prices at this point.
You mentioned, of course, we talk a lot about the CUSMA review coming up in the summer. How much is that actually going to factor into these stocks?
Well, you know what? I mean, I think they're trading outside of that because they've had so many back and forths from the tariff noise for years now, even before this administration. So I think at the end of the day, if lumber's needed for houses, these stocks are going to start to move.
What about Canadian producers in particular?
So, I mean, and the best ways to play them are the Canadian guys. So, West Fraser would be my favorite. It's got a good balance sheet. It's diversified. If you really want torque to the story, you could buy a Western Forest or an Interfor, but they are quite levered. And if I'm wrong and there isn't this restocking, that happens, and we have quarter after quarter after quarter, then these balance sheets are going to start to get harder and more pressed. So I wouldn't buy those. I mean, unless you're really risk-seeking in a non-registered account, I would buy the West Fraser. And that, to me, is not it's not a if, it's a when.
Why is that?
Because it's a staple. It's a household. It's not population growth. Eventually, people are going to start buying houses. Eventually, rates are going to come down. And these are cyclical markets. And you want to buy them when you're at the low point of the cycle.
We were talking off the top about the fact that these are not, like you say, look where no one else is looking. Not a lot of people are talking about forestry stocks right now. Is there a reason why they kind of slip under the radar, do you think? Or
well, it's a big market out there, right?
Yeah.
And
a lot of options.
It's a wheel, and it goes around, and it goes around. And you don't want to just be. You could be a deep value investor and just look at places that no one else is looking at. That's a pretty tough way to invest. I mean, look, we're finding value in AI, which is story number one. We're finding value in some metals places, which is story number two or story number one. So we're also doing what's popular, but you also want to look at, you don't just want to do what's unpopular just because it's unpopular. You want to really find a thesis there where you think that, hey, these are cheaper than they ought to be, and here's our catalyst that we're looking for, which is spring restocking for these forestry companies. Okay,
so interesting. We're going to take another quick break right now, but of course, Greg Newman is staying with us, and we'll be back in just a moment to see why metals are on his radar. Stay with us. Welcome back. Time now for On the Radar with Greg Newman. Gold, silver have rebounded after a historic collapse from all-time highs, lured dip buyers back to precious metals. That's what we're seeing today. And then our guest host, of course, Greg Newman, with Senior Wealth Advisor and Portfolio Manager at Newman Group, Scotia McLeod, has the metals on his radar. So it's been an interesting time for silver.
It has been. Well, listen, first of all, you saw this extreme overbought conditions. You saw, 46% above the 200-day moving average. So, you knew that there was going to be some massive pullback. And what was the catalyst? The catalyst was Warsh, who may be a hawk. Is he a hawk? Is he a dove? He wants to maybe lower interest rates, but he wants to lower the balance sheet. He wants to get rid of quantitative easing. These are all the things that have been part of the reason for the U.S. dollar debasement trade, which is cause these metals just to run. So if this guy is going to shrink the balance sheet and input fiscal discipline, have we seen the top of the metals rally? That's the question. And I would say in the case of silver, you got to look at silver, gold, copper differently. But silver, strong industrial demand, ongoing supply deficits, and ultimately, Warsh believes that AI and deregulation are going to push rates down, so that he's going to lower rates. So that should be supportive of the metal. So, I would say all in, this, first of all, this price correction that you're seeing is not over. Okay.
Interesting.
Yeah. Okay. So it's customary. You have a 30% down. You have people that missed the rally, thinking they're going to buy this dip, and it's up 12% or 15% today, so they're going to chase that. But it's not over. This will not resolve itself, probably, in my opinion, for a couple weeks anyway. Question is are we still in a bull market for the metals? I think certainly for silver, given those fundamentals, yes. But I think the rate of ascent or the speed of the rally slows for sure. Gold, kind of range bound, I think here. It might go a little bit higher. I think the real story is copper. For the thirst for green metals, the build out of EVs, it feeds into everything, and so you're still in short supplies. So I mean, and unlike the other two, I mean that is a real story of supply and demand. So you can really get your head around a little bit more.
So if we're looking, let's start with copper then, because as you mentioned, it's an interesting one too. Like, are there any particular copper mining companies that you like?
A lot. I mean, I like HBM. I like Capstone. I like Freeport. Lundin looks good. that's a few. I mean, there's a couple more. Within gold, I mean, the stocks are still cheap relative to the commodity. You got to give it that.
Right.
But they've all had a huge run. I'd pause on buying gold stocks, although if I was going to be buying, it would be Alamos, Aya, Anico, and Barrick. And in the silver complex.
Just sorry, why would you pause on buying any of those with gold? Is it because you think it might dip down a bit more?
Well, first of all, I think it depends on your time horizon. I mean, I think that this will take a while to resolve itself. So the stocks will be whippy. But the earnings are coming, and the earnings are going to be really, really good for these names. But the market already knows that. So I'm not sure that's going to be enough. It's going to depend on what the commodity does. In other words, I don't think silver is off to the races going higher. I think it's going to have to really resolve itself here. And then, and the same thing with gold. But I like the fact that silver has all these other kickers of supply deficits. I don't think you have the exact same thing with gold. So I think silver will perform, but and I think that so I would buy gold at a time, but not quite yet.
Not quite yet. Hold off for a little bit.
Yeah.
Okay, we're going to take a quick break right now. Of course, Greg Newman sticking with us today. Still ahead, though, we will dive into the world of sports betting and how Gen Z's betting habits are becoming a financial trend. And also, our phone lines will open soon for our first call segment, so you can call us at 1-855-326-6266, or you can send us an email here at firstcall@bellmedia.ca. We'll be right back in a moment. Shares of Palantir are climbing in the pre-market today. Fourth quarter profit and sales for the tech company beat expectations. The American company's full-year revenue outlook is also higher than analyst estimates. Revenue in the fourth quarter was boosted by a surge in domestic commercial operations and Palantir's work with the U.S. government. And shares of Pfizer are trading lower in the pre-market. The drug maker beat fourth quarter sales and revenue estimates. However, Pfizer's guidance came in lower than estimates. The American drug maker says some of its products are losing exclusivity, adding the 2026 guidance includes the anticipated impact of tariffs. And PepsiCo topped fourth quarter revenue expectations, benefiting from robust demand for its sodas in international markets, as well as strength in its low-sugar beverages in the U.S. The beverage and snacks company says it's cutting prices by as much as 15% in some of its key brands, including Lay's and Doritos, in a bid to lift its sales by offering some more affordable products. We'll take a look at the U.S. futures ever so quickly here. The Dow, NASDAQ, and the S&P 500 all actually trading up ever so slightly today as we kick off the day, and we'll continue to follow that for you. Sports betting is becoming part of how Gen Z handles money, and it's happening at scale. About a third of Canadians aged 18 to 29 are now betting online, turning sports wagering into mainstream money behavior. Joining us to unpack this trend that's shaping young Canadians is Hans French-LaRosa, senior behavioral researcher at the Center for Advanced Hindsight at Duke University. It's good to have you join us. Thanks for taking the time.
Thank you very much for inviting me. Happy to be here.
So this is a really interesting conversation. I mean, what is it about this moment in culture that makes sports betting feel so normal for so many people?
It's a very, very important situation and something that at the center we've started to explore and try to dig deeper over the past few years. And the thing that's happening is that we do see this trend that more young adults, Gen Zers in particularly, are spending more money and spending more time with sports betting and gambling. And most of this is a response to a phenomenon called gamblification. And it's essentially what's happening is that the lines between investing and sports betting and gambling have become more blurred, in a sense where platforms and apps and the environments where people are making these betting and gambling decisions have become much more similar to each other. Now, when we think about trading and investing and gambling, we see that both are starting to leverage delivering excitement to young adults, creating these learning patterns where people reinforce placing bets, gambling, and seeking those large gains, and creating uncertain outcomes that drive people to seek that as an opportunity. No? And we see, particularly for Gen Zers, where we see it's like there's a strong motivation to find that way to manage the cost of living, that way to manage and access more opportunities, but at the same time relying on an illusion of control that gambling and betting is leveraging for them, but it's not actually real, and it's starting to sort of like show negative outcomes for their finances in the long run.
Hans, I want to ask a question. I got a son, his name's Tanner, and he likes to invest, but he also likes to bet. He's betting on everything. He's betting on the tip of the ball and all these things that I had no idea. And
Yeah.
I was taught under the school that, you go into a casino, you're going to lose, but he tells me he wins all the time. Are these kids winning? Are you able to, if you're good at this, to turn it into something kind of like investing?
The challenge is that some are, and those who are visible figures in the space. Like when we think about why we do the things we do and why people engage in different threads, it's all about social proof. It's all about what we see other people doing, who are the voices we're following, and who are sort of like the things we're seeing on different social media threads and so on. And so there's some people who are winning for sure, but that's not going to be the rule for most people, right? And if we just focus on those who are winning, then the challenge is, will other people follow that and then make mistakes in the process? And again, when we think about investing and building wealth, what we're focusing is we really need time is our best friend when thinking about building wealth. It's just like slow putting our money into different specific funds and places where we can see growth. But young people are looking for that sort of like for that sort of like excitement in the moment, very short term, very, very quickly. And some people will win. And that uncertainty, that possibility of winning is what keeps driving motivation and excitement for people to continue doing that.
I guess that's why you call it betting. I mean, it sounds as though you're kind of erring on the side of caution in terms of how people should be approaching sports betting, right? Like, should younger people be looking at it as more as a form of entertainment rather than actually a way to make money?
Exactly. And when we think about what are some of the solutions, what are some of the things we can do to put in place to support young people, to support our community when engaging in gambling and sports betting in general, we're thinking about how can we add more individual guardrails to that. So if we think about it as an entertainment, then we can set up a set budget, for example, the similar way how we have a budget for how much we want to spend eating out. Can we set up a budget for how much money we want to spend every month on betting and gambling? If we win, amazing, that's great. Those wins sort of like we can use them for some other goal that we have, for a trip, for buying a house, things like that. But the challenge becomes when people start losing and we start chasing those losses and we go beyond the amount of money we had allocated and we decided to have just for that particular activity. That's when we see people entering those cycles where it'll be harder to get out.
Hans, at the end of the day, is it really just like a casino? Is it really something akin to, a blackjack table where you're going to win maybe, 45% of the time and you're going to lose 55% of the time? Is that what it's really like, or is there more skill and talent involved, in your opinion?
Yeah, that's a very good question. In the end, chances are what we've seen is that chances are closer to a casino than to a skill-based game. There is some skill involved, for sure. The challenge is that the skill and the people who win, when we look at some of the data, the people who are skilled and who tend to win more often, it's a very small majority. So we see very few people winning a lot of time, but most people in general losing most of the time they're placing bets and spending time on sports betting. No? So there might be some skill involved, but it's not something that's going to become common for most people. And the challenge there is if we just look at those particular individuals who are winning, who are very visible, then that might create an illusion that we have more control and more skill involved than what we actually have.
I wonder, too, like we're getting into such an era of sports betting, right? Like you can't watch sports without getting bombarded with ads about different sports betting companies. Is this just a phase, do you think? Or is this the way that, this generation is going to try? I take your point, maybe they shouldn't, but is going to try to be making some of their money through sports betting.
That's something that I think we'll have to see. But what I can say to that is it is by design that both betting and to some extent day trading as well are using similar tools to create that day constant attention-seeking engagement from people in general. When we think about how betting, like how one of these platforms work, is we have ads, cues, notifications, things that are calling our attention all the time. All of that then triggers a particular behavior. This is what we call a habit loop. They trigger a particular behavior, which is they make it very easy for people to just, with a swipe, with a tap, place a particular bet. And then we have the reward element. We're celebrating some of the victories. We are helping people chase those losses when they don't by giving them a second opportunity or giving them particular bonus. And we want to keep reinforcing that, or platforms want to keep reinforcing that particular loop. So the way platforms have been designed, they're going for that particular constant interaction. Now, I think the question and some of the things we need to keep an eye on is if this doesn't really become, and I think there's more risk than benefits at the moment, but if it doesn't become really a vehicle for people to build wealth, like we're missing the cost of opportunity of how much people could have built in terms of longer and more secure investments if they had spent that same money somewhere else than on gambling. No? So I think it's very important to see where's that line and help and steer people to treat this more as an entertainment and less as a vehicle for building wealth in the long term.
Okay, such a good conversation. Hans, appreciate you joining us this morning. Thanks so much.
Thank you both. Have a good day.
You too. That's Hans French-La Rosa, Senior Behavioral Researcher at the Center for Advanced Hindsight at Duke University. Well, still ahead, we're taking a closer look at what's driving the U.S. dollar slide with Bloomberg News, and our phone lines are now open. You can, Greg Newman, Senior Wealth Advisor and Portfolio Manager at Newman Group, ScotiaMcLeod, is going to be taking your questions on North American equities and options strategies. And you can call us. This is the number 1-855-326-6266, or you can email firstcall@bellmedia.ca. Stay with us. Currency traders recently unleashed a sell-off that drove the U.S. dollar into its deepest slide since the U.S. trade war began. Despite some ups and downs, the downward trend seems likely to continue. Bloomberg News takes a closer look.
It's hard to overstate how big and fast of a drop this is for the U.S. dollar. The value of the dollar affects everything from the price of an iPhone when sold overseas to how much you're going to have to pay for that summer trip to Europe.
This story is about the global community losing its confidence in the U.S. dollar and quietly quitting U.S. assets, but this administration doesn't seem to mind it.
The dollar had its biggest drop since U.S. President Donald Trump unveiled his universal tariffs last April.
Donald Trump imposes the steepest U.S. import levies in a century, with China facing a tariff of more than 50%. The dollar is also weaker.
The dollar fell in a really big way against major peers: the yen, the euro, the pound, the Swiss franc. This chart over the past month shows just how stark the dollar's drop has been so far this year. The vast majority of days, the moves are very slightly up or very slightly down. But on January 27th, the dollar fell 1.1%. That large of a move accounts for about 1% of all days.
To understand the current dollar decline, we need to broaden the lens here a little bit because it is coming off very strong levels. Even at the start of 2025, the Bloomberg Dollar Index was hovering at near the highest in at least 20 years.
The foreign exchange market, or FX market, is where investors buy, sell, and speculate on currency movements. The scale of the currency markets is massive. On average each day, some $9.5 trillion is traded in the currency markets.
Despite rising doubts about the dollar, it continues to be the world's dominant currency and has been so ever since World War II. It is the most used in global trade, foreign transaction, the FS market, and it also accounts for the lion's share of global reserves held by central banks, even as that has come off a little bit in recent years.
A number of factors can affect the currency markets, but the primary force behind the dollar's fall right now is Trump. Fear has been fanned by Trump's unpredictable policymaking, including his threats to take over Greenland, political pressure on the Federal Reserve to lower interest rates, and tax cuts that have deepened the U.S. deficit. Trump has indicated he's comfortable with the dollar's decline.
No, I think it's great. I mean, the value of the dollar, look at the business we're doing. No, dollar's Dollar's doing great.
His remarks underscore the lingering risks and the risk that global investors will look elsewhere.
It's becoming clear that tariff threats are being used as a negotiating tool on nearly every front, not just trade, and that casts a shadow over the U.S. economy at the time when growth is still fragile. If you look at the past 6 months or so, there has been little to no job growth in America, and that's largely believed to be the result of the trade war and the immigration crackdown.
The dollar's weakness has come despite a rise in Treasury yields and the Federal Reserve's reluctance to cut interest rates further.
For global investors who want to participate in U.S. stocks or play the AI theme, they may now be emboldened to hedge more of their U.S. dollar exposure given the dollar declines.
A prolonged and sharp weakening of the U.S. dollar brings with it a number of dangers for the U.S. economy. Trump in the past has made no secret of his desire for a softer dollar. A weaker dollar will boost American exports and promote American manufacturing. On the flip side, it makes imports more expensive for American consumers. It also comes at a time when there's sustained pressure on inflation from Trump's tariff policies. The U.S. has about $38 trillion worth of debt, many of which is owed to foreign countries, and a weaker dollar makes it all the harder to pay off that debt. The best case scenario is that a gradually weaker dollar ultimately does help promote American growth and exports. The worst case scenario is that a sharply weaker dollar ultimately leads investors to question the merit of investing in the U.S. That could lead to capital flight.
Despite U.S. stocks hitting record highs here recently, they've actually steeply underperformed global peers, and that suggests that investors don't have to sell America in order to hurt the dollar. They just have to buy less of it.
Trump's combative policymaking shows no signs of letting up. Still, not everyone's convinced that Trump's comments will lead to a long-term sell-off in the dollar. Major banks are telling investors to pull out and take profit on trades that wager on a weaker dollar.
We're already seeing the dollar rebound here a little bit, and that's likely to continue in the short run. After all, President Trump has already walked back some of those tariff threats, and the U.S. economy appears to be improving. However, uncertainty will linger just because you never know when policy risks flare up again, and global investors will want to be protected against that. So we may be headed in this very unusual situation where the U.S. economy does okay, the stock market is okay, the dollar not so much.
Bloomberg's reporting shows a real fear of de-dollarization among U.S. and international investors. And while there's a lot of reasons behind that fear, it's also been proven it will take time to play out.
Still ahead, we will take a look at some of the notable analyst calls and recommendations moving the markets, including ExxonMobil. That's coming up right after this. Welcome back. Let's take a look at some of the notable analyst calls and recommendations for today. ExxonMobil is cut to underperform from neutral at BNP Paribas, which says it struggles with the energy stock's valuation. The downgrade means Exxon has more than one sell equivalent rating for the first time since early 2022. BNP is one of just 2 sell-rated brokers among 33 firms tracked by Bloomberg. Analyst Lucas Herman raises the price target to $125 US from $114. And if we take a look at Adobe, shares there fell in extended trading, but recovered after Piper Sandler downgraded the software company to neutral from overweight. Analyst Billy Fitzsimons cites concerns over AI disruption and is also downgrading both Freshworks and Vertex also to neutral from overweight. Shares in JP Morgan, meanwhile, are edging higher as Baird raised the recommendation on the lender to neutral from underperform. Analyst David George sees the stock as still being relatively expensive, but says there is less upside to maintain a short position on the lender ahead of potential bank deregulation. Baird sets the price target to $280 USD, implying a 9.1% decrease from the last price. All right, when we come back, Greg Newman, Senior Wealth Advisor and Portfolio Manager at Newman Group, Scotia-McLeod, is going to take your questions on First Call. That's right after this. Welcome back to our first call segment. Greg Newman here answering your questions. And we're going to go straight to the phone line because we do have a couple of questions already. Margaret calling in from Sarnia with a question for us. Hi there. What's your question?
Good morning. Thank you for taking my call this morning. I've been a holder of Alamos Gold over the years, in and out of the stock, and I still own some. But it never seems to get much love. Analysts seem to promote it, Nico Eagle and Barrick, and I just think it's a great Canadian company, and I've done well with it over the years. I'd like to know your thoughts on Alamos Gold, please. Thank you.
Okay, thank you.
Well, you know, a little bit more of a junior, and this is a very risky space anyway, so people tend to shy away. So much rides on, you know, their exploration results, which, by the way, for these guys lately have been really great with Lynn Lake and, you know, showing pretty good reserve growth and resource growth. And, you know, shake it out. If you're looking for a gold stock that is nicely priced, it's trading around 15 times 2027. And we're modeling that they're growing their earnings from 24 to 26 at around 87%. So this is a good name in the sweet spot. You know, I think that the earnings that just came out disappointed a little bit, but their outlook was ultimately pretty good. So, you know, I don't know that I'd be buying gold, as I say, right away, because I think that this price action that we're seeing is going to take a while to resolve itself. But I expect it's going to resolve itself, you know, favorably. And I think that you can buy Alamos in there.
And if you already have it, a hold?
Oh, yeah. It's a hold, yeah.
Okay. Back to the phone lines now. Anita calling in from Markham with a question. Hi, Anita.
Hi, good morning. Thank you so much for taking my call. My question is on Microsoft. Greg, the price has come down a lot recently, and do you think it's a good buy right now, or should I wait for further dip? Apparently, they have the demand, but they don't have the capacity to accommodate that demand. What does that mean? I'll appreciate your advice, please. Thank you.
Thank you.
Well, Anita, you and I, you know, we go way back, and we've talked a little bit about other stocks before, and, you know, I've said when to hold and buy and sell. And look, you know what? The thing here was Azure was at 39% margins versus 40% Whisper. That was part of it. And as you said, there's capacity constraints. But there is nothing wrong with this company. This is really where you want to be. And after a fall like this and doubt like this, trading at this valuation and price to growth, Microsoft is a real nice buy here. So go ahead and buy it, Anita.
All right. Thanks, Greg. Okay, we're going to go to an email question now. This email coming in from Mike, and it reads, "Good morning, Greg. At this point going forward, do you still like Citigroup, or would Bank of America have more upside? Thank you kindly." Do you have a preference?
So great question. Yeah. You know, so if you step back, Citigroup has got the kicker of it being a real turnaround play. So it's getting all what the other banks are getting, which is, you know, the advantages of NIM tailwinds, deregulation tailwinds, you know, serious brisk investment activity, capital markets, but it also has this reorganization theme and improving return on capital. Bank of America has the same, but it's more of a deposit story. And when you shake it all out, Citigroup trading at around 9 times with a 17% growth rate. Bank of America trading around 9 times with about a 10% growth rate. So Citigroup still works better, and I think it's got a higher dividend as well.
Citigroup. Okay. We're going to go to another email now. This one coming in from Glenn, and it reads, "Hi, Greg. Is this a good time to build up a bigger position in select oil and gas stocks? Thank you." Yeah, I mean, we're seeing the price of oil going down currently.
Yeah.
Do you think this is a good time?
So yeah, I think that's a great question. I mean, we've been talking about the natural gas bull market finally having arrived, and then you see the NYMEX, which went down, I think, 18% the other day due to weather. Look, I think conditions are really there for natural gas, for AECO, for NYMEX ultimately. So I would be buying the gassy stocks. So I would be buying Arc Energy, I'd be buying Tourmaline, I'd be buying Peyto. But the oil stocks, no. I mean, Venezuela will take a long time. But Venezuela, the turn happened in 96, I think. And it took years and years of worse and worse. Venezuela is probably going to get better and better for them in terms of exporting eventually over the next say, 20 years. Iran might change. Like, there's a lot of supply that is coming on. So for the oil markets, I wouldn't be buying oil stocks here, no. Unless we're looking at, Canadian, like a CNQ, and it gets cheap enough because we have our own fundamentals here in Canada and our differentials and it all getting out from the TMX and that sort of thing. So, but by and large, I'm staying away from oil.
I think we've got a minute left. So very quickly, one last email, this one coming in from Len. It reads, your outlook for top-tier Allied Properties REITs.
So REITs have been poor for 5 years in a row. We're looking for the turn. Will demand finally pick up in the office complex? You're seeing maybe some signs of that with some M&A activity, possibly. Allied has gotten very, very cheap. They've done their distribution cut, so I think that they've cleaned their house. I think they're in a good situation now from a valuation point of view that the bottom is, we've probably seen the bottom, but if we haven't, we're pretty close. So I think for patient capital, you can buy some Allied property here.
Okay, that is all the time we have. Appreciate you coming in studio today. Thanks so much.
Thanks,
and that's it for us here on The Street. Again, thank you to Greg Newman, Senior Wealth Advisor and Portfolio Manager at Newman Group, Scotia McLeod, for joining us today. Andrew Bell is next with the Open. Markets are opening just over 30 minutes from now, so stay with us.